Decoding the markets, an introduction to technical analysis. Technical analysis is like studying the language of the market. It involves studying historical price and volume data to predict future price movements. Technical analysts believe that price discounts everything. Instead of analyzing external factors, they focus solely on price action. They use charts, patterns, and indicators to get insights into market sentiment and potential future price trends. Whether you are a seasoned trader or just starting, understanding the basics of technical analysis can give you an edge in the market. In the following sections, we'll delve deeper into chart patterns and indicators to make more informed trading decisions. Chart patterns, unveiling the secrets of price action. Chart patterns are like footprints left behind in the sand. They tell a story of where the market has been and hint at where it might be going. By recognizing these patterns, we can anticipate potential future price movements. An upward trend with higher highs and higher lows suggests bullish sentiment. Conversely, a downward trend with lower highs and lower lows suggests bearish sentiment. Chart patterns can be continuation patterns or reversal patterns. Continuation patterns indicate the prevailing trend is likely to continue, while reversal patterns signal a potential shift in direction. Understanding and identifying chart patterns is an essential skill for any technical analyst. Head and shoulders, tops and bottoms, recognizing common chart patterns. Let's dive into some popular chart patterns. Head and shoulders. It signals a potential trend reversal from bullish to bearish. The head is a peak higher than the two surrounding peaks forming the shoulders. A break below the neckline confirms the pattern and suggests a further price decline. Double top. This pattern, resembling the letter M, indicates a potential trend reversal from bullish to bearish. It occurs when the price rises to a certain level twice but fails to break above it. A break below the neckline confirms the pattern, suggesting a potential downtrend. Double bottom. This pattern resembles the letter W and signals a potential trend reversal from bearish to bullish. The price drops to a certain level twice but finds support and bounces back. A break above the neckline confirms the pattern, suggesting a potential uptrend. While chart patterns can be powerful tools, they are not foolproof and should be used with other technical indicators for confirmation. Section 4. Beyond the charts. Navigating the world of technical indicators. Technical indicators offer a quantitative approach to analyze price data. They help measure the strength and momentum of a trend, confirm observations from chart patterns, and alert to potential overbought or oversold conditions. Let's look at two commonly used indicators. Moving averages. They smooth out price fluctuations and highlight the underlying trend. For example, a 50-day moving average calculates the average closing price over the past 50 days. Traders use moving averages to identify trend direction, potential support and resistance levels, and generate buy or sell signals. Relative Strength Index, RSI. This indicator measures the magnitude of recent price changes to evaluate overbought or oversold conditions. It oscillates between 0 and 100. Readings above 70 are considered overbought, while readings below 30 are considered oversold. Indicators should not be used in isolation but combined with other tools and techniques for a holistic view of the market. By using a combination of tools, you can make more informed trading decisions. Section 5. Weighing the scales. Benefits and limitations of technical analysis. Benefits. Simplicity. Once you understand the basic principles, you can apply them to any market or time frame. Visual representation. Charts and indicators provide a clear way to visualize market data, making it easier to identify trends and potential trading opportunities. Wide applicability. Technical analysis can be used for various trading styles and asset classes. Limitations. Reliance on past data. While past price movements can provide valuable insights, they are not always reliable predictors of future performance. Subjectivity. Different traders may interpret chart patterns and indicators differently. Not foolproof. Technical analysis is not a guaranteed path to profits. By combining technical analysis with other forms of analysis and continuously learning and adapting your strategies, you can navigate the complexities of the financial markets with greater confidence.